Well, hi everyone, and welcome to Buffett and Beyond Research Stock of the Week, or I should say Stocks of the Week. And we're going over something very unique this week, which I've alluded to in my daily letters. But today we'll go over it in a little bit more detail. Which is a better buy, Amazon or Nvidia? And this is November 8, 2025, and we're a week into this month already, folks. Thanksgiving is next on our agenda. All right, Amazon or Nvidia? So you're going to be surprised at this. And remember, if you want to live on this beach like Jimmy Buffett used to do, you've got to learn how to invest even better than Warren Buffett does now. So let's look at some numbers here, Nvidia and Amazon. So let's look at the 5-year price growth right in here. Nvidia up 1,232%, and we've had Nvidia in our portfolio this entire time. Amazon up 46.6%, which is not bad, but look at the S&P up 91.5% over this time frame. So in other words, Amazon, the big story Amazon, which is all over the place and owns the world, as some people want to say, is doing half as well over 5 years as the S&P 500. And both of them are totally almost non-existent compared to what Nvidia has done. Now, the year-to-date price growth, so from the beginning of this year until just the other day, we're looking at Friday actually, for Friday morning, just before the market opened, Nvidia is up 40% for the year, Amazon up 11% for the year, and the S&P up about 14% for the year. And as I said, this is Friday morning before the market opened, and so all of these are down a little bit. But year to date, we're looking at Amazon again underperforming the S&P 500, both of them being totally overshadowed by Nvidia. Now, the forward PE ratio, and I don't like to use PE ratios too much, reason being that which PE ratio are you talking about? The trailing 12 months, the next 12 months, the future 12 months, which, don't forget, is a guess on earnings, or as Value Line does, the past 6 months of actual returns and their projections of the next 6 months. So they get 12 months in there. But it's a PE ratio that's unlike all the other PE ratios. So you have to be on the same track when you're comparing one PE ratio to the other. Right now, we're taking what is the price today, or I should say as of Thursday's close, what was the price at Thursday's close, and what were the projected earnings for 2026? Now, we look at the forward PE ratios. Let's look at the S&P first, 23.4%. And that's pretty high, but we are in a bull market. Don't forget that. So up 23.4%, or the forward PE ratio, 23.4%, again, which is high, but we are in a bull market. Amazon, you would expect it to be higher than the average stock in the S&P 500, sitting at 35%. Okay, a little high, but it's a growth stock. Now look at Nvidia. Nvidia is really a growth stock, and it has the same forward PE ratio as Amazon. So when we ask the question, which is a better return right now for the money that you're going to invest, and we have to say it's Nvidia. Nvidia is growing so fast, but the forward PE ratio is the same as that of Amazon. So we're looking at Nvidia as being undervalued even at this price. Now, what about the earnings growth for 2026? And these are projected, of course. Nvidia 39%, Amazon 13%, the average stock in the S&P 500 13%. Revenue growth for next year, 26% for Nvidia, 7.2% for Amazon, 7.1% for the S&P 500. So we are looking at Amazon as being a stock that is performing equally as well as the S&P 500 in the numbers, but when it comes down to actual price return, it is being underwhelmed by the S&P 500. Now, why is that? What we can say is that Amazon's earnings are growing at a slower rate. Their revenue is growing at a slower rate than it has in the past. So we always know that the market always overshoots or undershoots one way or the other. So it's taking it out on Amazon that, okay, Amazon, you're slowing down, you're becoming an average stock. Meanwhile, Nvidia just keeps growing and growing, because what they say come out, or what did they come out with this past week, that they have 2.5 times the orders of the chips that they can provide. So yeah, Amazon has orders, backfilled orders, needed orders, forward orders that are just can't be filled right now. And Nvidia, of course, is putting money into other companies to make certain chips for them. And we're talking about Intel, number one. So we'll leave it at that. But we are looking at just the numbers, never mind what they're saying out there. And the numbers are showing that Nvidia is priced the same as Amazon, but Amazon earnings and revenues are slowing down, where Nvidia's are expanding. Now let's look at our charts, and this is Amazon compared to the S&P 500. So when we look at Amazon compared to the S&P 500, S&P 500 is in blue, Amazon is in green. We're seeing their clean surplus ROE is still high, above the 20% threshold for our growth portfolio, and it's about almost twice as much as the average stock. Net income, almost twice as much as the average stock. Revenue, more than the average stock, but starting to slow down. See, this is the 5-year average now. Don't forget that. Nvidia, 5-year average compared to the S&P 500. Wow, we're looking at, 5 times the clean surplus return on equity. And you know what we like to do is we like to say, okay, if we compare this to a bank, which bank would you rather put your money in? One that's giving you 25% or one that's giving you 73%? Yeah, no doubt there. And the net income, it's 7.5 times that of the average stock. Again, the average stock, the S&P 500, is in blue. And then we come to revenue, we're talking about 6-7 times that of the average stock. So we can see that Nvidia on a 5-year average is overpowering Amazon. Now let's compare Amazon to just Nvidia. And here we go. So this is Nvidia versus Amazon. Amazon is in blue. And again, bank account. Would you rather put your bank account, and this is 5-year average, in one that's returning you 34% or one that's returning you 73%? And look at the net income difference and look at the revenue difference. Wow, big difference there. So we're looking at Nvidia in a totally new light, because we thought, we compared it to Palantir, and Palantir, let's go back to this. Palantir is not a forward PE ratio of 35%. It's something like 250%. So a stock like Palantir is pretty well overpriced relative to the projected earnings for next year. But of course, the market looks way ahead on some of these stocks. And so Palantir, with the forward PE ratio of 250, or it was up in the 200s, and it changes every day, of course, where Nvidia is only at 35%. So we kind of like that. Nvidia is right in that area of growth stocks that are better growth stocks than some of these high flyers that are 200 times earnings, 250 times earnings. So, those are dot-com bubble type of forward PE ratios. So let us look at a chart of year to date, and the black line is the S&P 500. So this is a price chart. Black line is the S&P 500. Blue line is Amazon. You can see Amazon is underperforming the S&P 500, as we showed you in the other tables, but this is a price chart, and Nvidia is all the way up here at about 40% for year to date. And you can see what's been happening this past week as as we're speaking because the tech stocks are getting hit pretty hard. 5 years, yeah, come all the way down here. Blue line, the bottom line down here is Amazon, and the black line is the S&P 500. And the S&P 500 is almost outperforming by 2-to-1 over Amazon. Who would have thought that? If we just look at Amazon and say, wow, Amazon Prime is at our door every other day, and Amazon Prime trucks are all over the place. It's in every area you could possibly think of, and it's doing all sorts of things out there. But look at Nvidia all the way up here, 1,232% over 5 years. So, and it has the earnings to show for it. That's the thing about this high-flying stock. Otherwise, you would look at a stock like this and say, holy cow, I'm not going to go near it. But this stock does have the earnings to show. Where some of the stocks out there, and I'm going to include Intel out of that, the only reason Intel's going up is because Nvidia is going to give it money in order to buy its chips. But until it starts making money, I'm talking about Intel, until it starts making money, to us it's just an average stock, and we don't want it. Will we prove to be wrong? Well, let Intel show us that we're wrong. Let Intel show us that they can make money. So when they start making those earnings, then we'll think about possibly buying it. But until then, no, because it's promises. This stock, Nvidia, is actually making the money. And it seems to be sponsoring a lot of other stocks, semiconductor stocks, so it can make chips for Nvidia. All right, folks, so there you have it, Nvidia versus the S&P 500, followed by Amazon, which has been doing dismal over the past 5 years. So here we go, folks. We think that Amazon may not be in our 2026 growth portfolio, and we hate to say goodbye to Amazon because we can't even guess at how long that's been in our portfolio and doing so well for us. But lately, not so much. It's following the S&P 500 fairly closely, but not enough. We want stocks in our portfolio that outperform the S&P 500 and are safer also. So we need stocks that are generating earnings because price follows earnings. When you look at a comparison line of earnings versus price over the past 100 years, you will see price follows earnings. So a company has to have earnings for us to invest in it because we are investors and not traders, and we don't guess at tomorrow. We say who's making money, who's making increasing amounts of money each year, and we'll go with that. And most of the time we're right that good companies or companies that have been good in the past continue to be good into the future for a long time to come. And just one more thing, we want to show the past 5 years of just Amazon versus the S&P 500. S&P 500 is this black line up here. Amazon is down here, and we can see that it fell more. This is 2022 when the S&P was down 19.6. The NASDAQ was down 34%, and we can see that it was a tough year for everybody's portfolio, and we can see that Amazon fell more than the S&P 500, and it came rallying back, but still cannot catch the S&P 500. So we're disappointed in Amazon. Well, it's such a big company, and the earnings are starting to slow down. So, folks, we had a tough week this past week, and the market is going to close lower for the week. It's just not closed yet, and this is Friday morning that I'm recording this. And so go out there. You walk on this beach like Jimmy Buffett once did because you are investing better than Warren Buffett. So enjoy the weekend. Take your mind off the market. Be with your family. Have Sunday dinner. But most of all, folks, be safe, and we'll see you right back here in a couple of days.